Here we go. A whole bunch of people coming in. Good morning, everyone. Thank you so much
Morning.
for joining today's Agent 21 in Mortgage Masterclass. So it's been such a hot topic this year. Everyone's talking about the industry and rates and how do we handle this. And as real estate professionals, everyone needs to know exactly how to convey this to their clients. So that's what we're going to go through today. I'm Bryan Atwood, broker owner of Atwood Mortgage, and I have a
Uh,
fantastic co-host here.
and your fantastic co-host, yes, Pete Mergens, the associate broker manager of Century 21 Atwood in Northfield.
All right. Well, we're going to go through a lot. I would strongly like to encourage questions too, because we have Pete and I share a lot of stories and client situations that we have to work through. But one of the benefits of such a diverse group is everyone sees something different, and we're happy to kind of talk through that. But let's go ahead and get started. I can dive right in. Obviously, like I was saying, it's just such a hot topic this year. There's so much going on in the industry as a whole, and especially with the mortgage market probably being one of the most complicated periods in the mortgage world that we've seen in a very long time. So it's very confusing. It's very volatile. Why are things happening? And I want to kind of just tee it over to you first, Pete, and kind of say, from boots on the ground as you're working with clients, buyers and sellers, what are some of the most common questions that you're hearing from clients about mortgages and why it's helping or hurting what they want to do with their real estate?
Absolutely. So probably right now, the most prevalent thing I see are clients saying, well, gosh, I heard rates are down. And there's really a strong disconnect. People's understanding that the actual mortgage rates are not tied directly to the Fed interest rate, unless, of course, they happen to have a loan that's tied directly to that. It's really one of the most confusing things, but it's an incredible opportunity to educate people and to help them understand what the possibilities are for them.
Yeah. So if we go to the higher level and look at it, as you mentioned, and if we've talked to our agents about a lot, those two things are not tied. Fed rates and mortgage rates are not directly connected. They're absolutely influenced. However, mortgage rates are always forecasting quite a ways out into the future to try and predict what's going to happen, and that's what affects bonds. And I'm saying this kind of confusing level for a reason. So they're going the last two Fed rate cuts we just had, everyone was so excited about, and both Fed rate cuts in the last several months, immediately after we saw mortgage rates rise. Like, what is going on? And then the news is celebrating and everything else. So it's very confusing. We can deep dive and kind of go through why that is happening. Again, the main reason is because they're forecasting. They were already expecting those cuts. And then when they happened, they went, okay, great, what next? And they said, we don't know. We're going to hold off for a bit. And then mortgage bond investors freak out. So it's a complicated scenario. What are some ways that we can kind of talk to our clients and make that less complicated?
I think for me, not trying to remember, we're experts at a lot of things, but unless we're loan officers, we're not talking necessarily about specific interest rates and things. That's why we want to get them to Bryan or another loan officer. It's very important, though, that we all have a grasp of what we're doing. So trying to explain to our clients that, hey, right now, because of the low inventories, these properties out there that they're looking to buy are going to appreciate, between 4 and 5% this year. Okay. So that, interest rate that they might think they're going to get or hope to get by the rates falling will not offset the amount that home is going to appreciate. So if they wait another 6 months or wait a year and hope that interest rate comes down, they're actually missing out on a lot of equity or appreciation in that property. It far well offsets what they would spend in an interest rate. So really explaining to people how this matters is so important. And it's important that we as real estate professionals understand that difference.
Yeah, absolutely. And one note on that point you just made, it's impossible to predict the market, right? We don't know exactly what's going to happen, and I don't want to step on another point I have here coming, but nobody really knows. We need to do our best to be educated and to try and interpret what is happening so we can best put our clients in the best position to move forward with whatever they want to do. But it's impossible to really know. What I talk to some clients about is like, I know it's scary because we're tying into a 30-year mortgage. That's a long time, my goodness. However, you're not really tied to that 30 years, right? You're tied to the debt. That's the main commitment you're making, is you do have to repay that debt. The term, it can change on any refinance that you do. So you can maintain that term, you can lower your interest rate, you can shorten the term, you can change that. The main obligation is just that liability. So don't stress about the 30-year term so much. Focus more on, is this the right all-encompassing solution for you? And then we can focus on like, okay, if we changed our thought and said like, yeah, don't pay attention to the rate, let's pay attention to some other factors like our monthly payment instead, because it can only get better from there. Before I move on to another spot, a couple other questions I know people are asking, and I'm curious both your thoughts and how you talk to clients about it. First off, really easy one. Are rates bad right now?
No, statistically, we're the average of a 40-year average. So I would say rates are really good in comparison. People they kind of have short-term memories, of course, and they consider that, oh, the 3% interest rate that I got, I'm going to wait for that to come back. Well, we may likely never see that again, right? So those are what people are thinking about, considering. Some of them might be locked in at an interest rate like that and saying, well, I don't know if I want to, leave this rate that I have in this house for another property. But why are they looking? They need more space. Well, that's the cost of it.
Right. Absolutely. So your thoughts, what is going to happen to rates in the next couple of years? Is it an okay time to buy?
I think it's an exceptional time to buy if that is what your desire is. You should move for the right reasons. It shouldn't be based on, I'm hoping to save money, I'm hoping to, take advantage of some equity, whatever the case might be. You should be moving for the right reasons, and it shouldn't be driven based on the interest rates or things of that nature.
Absolutely. It's like your family needs, your life needs, changes that are going to happen have nothing to do with the market. They really don't. And like when it's your time, when you have to make that change, then it's time to make that change, and we'll need to make the best out of whatever market we're in. It comes and goes. The market's always up and down, and it's impossible to time it. The big takeaway I have for clients is just to let them know that, like, I know the big scary number, seeing 6s and 7s on interest rate is scary. But the one is, after your closing, you don't pay a whole lot of attention to your interest rate. What you pay attention to is that bill you're getting in the mail every month, right? What is the payment you have to make? Well, let's focus on a way to put that strategy together and make sure that you are comfortable. It's fitting within a really sound budget for you. And if maybe we reached a little bit, but we're hoping to refinance, as long as we're happy with that higher payment, then we're good, right? Doesn't really matter if it's a 2% or a 10%. Does it fit within your budget, and are you happy with those choices that you're going to make? Then it all makes sense. People are borrowing, not to get on a tangent, but people are borrowing literally trillions of dollars today on credit cards, paying 20 to 25% interest. And that they don't think about, because it comes down to what they pay attention to is the $200 monthly payment they had to do. They didn't care about 25%. It was $200, right? That's my minimum payment on my card every month. So it's not as big of a deal. And similarly, with a primary mortgage, it's always going to be the cheapest money that you can borrow. And if we focus on that monthly payment, we're going to set them up for a lot more success. Any other thoughts or questions on that before kind of going to the next topic? Okay. Perfect. So with that, right, we know the market's volatile. We know it's changing all the time. Interest rates change every single day, sometimes multiple times per day. The housing market has its super hot periods and little cooled periods, even though it's been a weirdly busy December. I don't know if you're seeing that too. But like, people are out. A lot of multiple offer situations still. I think people are just kind of adapting to this new norm, right? They're like, they know that rates are where they are. There is no guarantee that they're going to be going down in the coming months. So if now's the right time for my family, let's focus on moving. But one thing that we like to try and educate on is what are some ways that we can help buyers and sellers see that value today and get the most out of the situation that we're all in to still put really great deals together. So few things I'm kind of thinking through are one is just starting off with that budgeting discussion. We want to make sure that people are having a really great discussion with a loan officer and maybe collectively. So it's not a bad thing for realtors to be involved in that discussion too, right? We can take care of these families together. We can sit down and say, let's go through this budget. Let's figure out the real price point, not the price point that you search online because those houses are the prettiest. What's the one that's going to fit for your family? And then also thinking through a price point where you can be aggressive, right? If we say you're approved to 300, are we only shopping at 300? Because other people probably are too, right? So sometimes we're in a situation that we might want to go over list price, find more ways to be competitive, offer more incentives to sellers to be able to get our deals accepted. But otherwise, creative negotiating, what are some ways that you're using as far as on offers or with sellers even? I know we've had some great conversations about how can we just not do this cookie cutter, okay, here's our offer and we accept it and we're done. Ways that we can set up buyers and sellers for success with really smart strategies and offers to get accepted offers.
I think for me, of course, one of the things I didn't mention in the beginning is I am also a business development manager for Atwood Mortgage. Thank you, Bryan. And one of the things that has been a tremendous benefit to me as of late has been with my listings, as an example. Because, when we look at listings that have been maybe sitting on the market for 30 or 40 days, or 50 or 60 or 70, whatever it might be, because I have a few of those, I know that for sure. What I have been finding is to go back to that seller and say, hey, we need to reduce your price, or it looks like a good idea to reduce your price. And they might reduce their price by $10,000. Mm-hmm. That $10,000 savings to the buyer is only worth at, on a 30-year interest rate of today's rates, $6.48 a thousand, or $64 for that 10,000. Okay, that's what we're saving that potential buyer. However, if we look at things differently and talk about, hey, Mr. and Mrs. Seller, what if we were to offer some form of a buy down point, or a 2-1 buy down, something that has some real significant value to a buyer, that is huge incentive to maybe help somebody along. And where I've been trying to utilize that is when I do have a showing on that property and I see their feedback and they have some genuine interest, whether they're writing an offer or maybe we're going to write a reverse offer to them. Hey, noticed in your feedback that your clients were very interested. My clients and I have been talking, and we have a possible incentive that we want to offer to you guys right now. And it's as simple as like letting us get you a second opinion on your mortgage as well, and maybe us offering a 2-1 buy down, provided your client fits into a certain criterion. So I've actually had that opportunity several times, and it has worked out amazingly well. And it's something I keep in my repertoire right now all the time, because that same scenario, depending on the price of that house and how much money they're putting down and so on and so forth, might cost my clients maybe slightly more than that $10,000 to do a 2-1 buy down. But in that scenario, it literally could save a buyer $400, $500, $600 a month in their payment for the first year, and half of that for the second year. It's incredible.
Yeah, it's a fantastic tool, and I think it's been horridly underutilized, just because not everyone understands it, and we go back to what we know and say like, hey, well, we've been on the market, we need to have a price improvement, right? We have to get under that next tier, or maybe we just call it 10,000 to reignite that flame. And sometimes that's not it. And I want to emphasize what you just said there in doing these reverse offers. A lot of people, I think, will do reverse prospecting, and they'll go through the list and all the people and then send out a message and be like, does anyone want it? I'm like, we can be more creative. We can provide solutions, figure out, hey, they looked at the property, they have it loved on the MLS. What was their holdback from moving forward, right? Is there something about the property? And sometimes it might just be, it was kind of at the top of their budget. We didn't know if we wanted to stretch that far. Just amazing door open to be able to say, well, what if we can help make that easier? What if we can, because $10,000, as you said, nobody's going to make the choice or the decision on buying a house or not over $60. Just not. But if all of a sudden you can say, wait a minute, I can save a few $100s per month in the first year, maybe save some additional savings that we're able to find depending on what they might have already pre-approved for. So those are reverse offers, knowing your mortgage tools and being more creative, I think is going to be probably my favorite theme from today's meeting. Just in like, how can resellers can make the offer too? Like, let's put this together. Let's make everyone win.
Even as we sit here today, it's the 12th of December. A lot of people have gone into that mode a little bit of, well, it's the holidays and gosh, not a lot is going to happen right now. I've been going back through all of my listings, all of the feedback, and I'm looking for anybody on there that showed some genuine interest, but I just haven't heard from. I mean, we all have that happen where, oh, we're very interested, and then we call them and talk to them, and they're like, well, there was this or that or some issue that they didn't like. Go back to those people now and go, hey, has your client bought a house yet? They showed interest in this particular property 2 months ago. Have they bought yet? You know what I'm finding? In most cases, they have not bought yet. Like, I would say out of the maybe 15 or 20 calls that I have legitimately made, probably 15 of those 20 have not bought a house yet. So it's worth going back to them and just saying, hey, listen, I know your clients like this house. My clients might be willing to offer a pretty impressive incentive to you under some of these conditions. And we as real estate professionals need to constantly be looking for new ways and understanding the power we have with our loan officers and things that we can do it's really impressive. But lastly, I want to say the converse to all of that, of course, is representing a buyer and being able to potentially offer in that same capacity rather than coming in on a property that say it's 450,000. It's been on the market for 90 days and, we're going to come in 10 grand light. Maybe we offer them the full price, but we are going to ask for a 2-1 buy down, putting our clients in a substantially better position. And some people don't want to confuse the matter, whatever. It's not that complicated to explain and offer these incentives.
Yeah, absolutely. It just comes back to, again, understanding what they are. There's been such a disconnect, I would say, industry-wide and embarrassingly within our own company prior to a few years ago when we launched Mortgage, that we just didn't know these things. Our team became just so great in their lane, but real estate encompasses everything, right? We should be knowledgeable, we should be experts on everything, know those tools, or at least know what's out there and how to make the connections to provide some more solutions. So a couple thoughts for everyone. I just wanted to reiterate on this because you're sharing some really great ideas and maybe not everyone might know how they work. Step one, there's kind of two parts to any temporary buy downs. First off, making sure you understand the seller concession limits on different programs. It is vitally important. It is different for every single loan program. We have a loan programs cheat sheet. So if you don't have that, please reach out and I will send it to you. One that gets people a lot. I actually just had this the other day with somebody that was negotiating a deal and they were asking for 3% seller concessions. The seller was actually willing to give more than that. They wanted to because they knew there were some things in the property. They didn't want to fix it. Like, let's just give you some more seller concessions. On a conventional loan, if you're putting less than 10% down payment, 3% is the limit. And the seller, again, just not doing this every day, is like, I've seen plenty of loan officers get more than 3%. Maybe you should talk to somebody else. I told that to my client. And like, it's more complicated than that. On a conventional loan, 3% seller concessions is the limit until you're putting 10% down. Once you're putting 10% down, then it goes up to 6%. If you put more than 25% down, you can actually get up to 9%. I don't know what you'd spend it all on, but you can get up to 9%. On FHA loans, 6% always. right? And we've had probably some people on this call that have gotten 6% seller concessions. So you can accomplish a lot of things with that. USDA is also 6%. VA is kind of unlimited. I say kind of because there is going to be some things that we just can't throw in there. A lot of people think it's 4% though. They think they can maximum they can get is 4% seller concessions. And what the VA guide actually says is you can get 4% seller concessions on top of paying for all the closing costs. Like, well, wait a minute. Like, why would we do that? And the reason is because so the seller can pay all of the closing costs, including up to 2 discount points, and then give another 4% that the veteran can use for other miscellaneous things like paying off debt. Maybe there was another way to be creative. Maybe you had a veteran buyer on one of your properties, and they're like, you know what? It was at the top and maybe even a little bit over their budget. We probably shouldn't have looked, as a reach. Well, maybe it would be in their budget if we could get some seller concessions to help pay them off that loan that's coming due, in the next year. And now that frees up all that monthly income so they can put it more towards a house. I've seen some people that have paid off up to $50,000 of a veteran's debt through seller concessions to get a deal done. It was a much higher price home, of course, but still incredible deal. No loan program lets you do that. So I share all this first to say know your concession limits. If you're hoping for closing costs to be covered just as part of the client, and a lot of people are right now, we need to make sure there's room for the temporary buy down if that's a plan that you have. So the most common temporary buy down is the 2-1 buy down. That's the one that Pete was talking about. The way that it works is if your rate today is at 6.5%, in year 1, you're actually gonna get a 4.5%. You get that for 12 months. After that, and that's the 2 portion of the 2-1. After that, you're in the 1 portion, which is a 1% discount. You're at a 5.5%. And then after 2 full years, you're back at the 6.5%. And maybe, can't guarantee it, but maybe there would have been a refinance opportunity before that happened anyway. So you might not ever pay that 6.5%. Saves hundreds of dollars per month. And again, they're still qualified. I've been asked this too. Are we putting buyers in a bad position by doing that? Right? We're not qualifying off the 4.5. We're qualifying off the 6.5. We're making sure it works with them. It's in their budget and they know that payment. And now we're just going to give them a discount for a couple of years. So as far as the 2-1 buy down goes, the average cost for it, because it does depend on the borrower, their amount of down payment and the interest rate they have, the average cost is somewhere between 2 and 2.5% of the purchase price. So again, on a conventional loan, you can get up to 3%. It's going to be somewhere in that window, right? If they're doing minimum down and they have a really high interest rate, it's more expensive. If you want to do something like a 1.0 buy down, just give them a discount for 1 year. That's usually in the realm of 0.7, 0.8%, much less expensive. But amazing tools. And last thing I just remember is to your point earlier about, sometimes, that 2% might cost more if it's a higher price listing. The 2% stays the same if it's a $250,000 listing, and now maybe it only costs the sellers $5,000 to give that incentive instead of a $10,000 drop. It could save the sellers money, save the buyers a ton of money, and you sell at a higher price point. So kind of a win across the board. The last note I have on this is just as far as ways to be creative strategies. So better budgeting, creative negotiating, doing reverse offers, knowing what we can offer with mortgage tools to get deals together, and then also shameless plug, work with a lender that costs less to begin with. Okay, you're kind of shooting ourselves in the foot if we're saying hey, we're going to send this client up to this giant online lender who's going to charge 4 to 5% on the back end, and they just roll it into their that's a true thing that people are just being gouged on that. On average, brokers save over $10,000. So if not Atwood Mortgage, just a broker as a whole should be a better solution for clients and help get those deals done. So let's see. I don't think we had any other questions on here right now. Pete, what else are you kind of seeing as far as just things happening in the market, things that create other unique things you've seen with clients, tools that you've learned this year, maybe through BDM?
Well, one thing I want to say before I answer that question is, speaking as a realtor who's been doing this for almost 23 years now, the one thing that I think I've learned the most in the last year for myself is not being afraid to be involved. And what I mean by that is sometimes, we've been, as realtors, we've kind of been trained to pull back a little. I mean, going back to, well, now we have trust funds, so we don't make people write checks that we deliver hand to hand. We back when I started in the business, of course, it was customary to ask for the opportunity to present directly to a seller. Really, they've taken away all of our abilities as people to communicate with people. And kind of the strongest thing that I've learned after becoming a business development manager and understanding mortgages better is that you can't be afraid to speak up. It takes but a minute to just say, hey, no strings attached, but you should get a second opinion. Did you interview more than one agent when you got to me? Yeah, you probably did. Well, you should probably interview more than one loan officer. It matters. It matters to work with people that you trust and feel connected to. And so for me, just in the last year of being a business development manager, not being afraid to speak up. I can just say anecdotally, this last weekend, Bryan was able to help me. I was in a car ride out to southwest Minnesota to go to a competitive shooting event. And, one of my friends in the car is telling me about his daughter refinancing. And I'm sitting in the back seat going, oh my gosh, what should I do? What should I say? Should I say anything? Do I even want to go there? And so I just inquired a couple of questions, asked some questions, and said, what's going on, and who's she speaking to? And I just said, listen, I'm a business development manager, and our Atwood Mortgage has the ability to help. We have some strong resources. He called his daughter right there in the car. I sent her my link via text, and within less than an hour, Bryan was speaking to her. Mm-hmm. And Bryan is able to save. And Bryan, I don't want to put you back on the spot, but without giving away too much, what were you able to potentially save her in a short period of time?
Yep, for their refinance situation, what they wanted to do, once we got everything in, kind of assessed it together, they're going to be saving about $7,000 on their refinance.
The amazing thing is, for a brief moment, I thought I'm just going to leave it alone because they said, well, we have an appraisal scheduled for Monday.
Yeah.
And I thought, oh, shoot. And I said, did you pay for that appraisal? She said, yeah, we had to pay in advance. I said, well, if you cancel it, you should be able to get that money back, but there's no guarantee at this point. And I kind of thought, well, we'll leave it alone. Well, Bryan was able to get an appraisal scheduled for Monday.
Same day.
Same day. And it matters to be able to speak up. It just takes a minute. Sometimes we have to get out of our comfort level. We're there to help. And it really is remarkable what we have at our fingertips through Atwood Mortgage. So I do want to say publicly to you, Bryan, thank you, because you also instill confidence in me to tell me that it's worth it. It's worth having that conversation with somebody. Maybe they say no thanks, and that's where you leave it.
Yep.
So.
Absolutely. And we're not ever going to try and be that one stop, everyone should be going to Atwood Mortgage. No, but we do want to have that confidence for everyone to know what's out there, what's available, and really recognize when your client's being taken advantage of. Because I'm sorry, I when I look at it and see, I know some loan officers personally that I think are fantastic people. And they do a really, really good job. They know loans. They're great. And every single one on this call can think of a few of those loan officers. I think they're fantastic. But if they're selling garbage and they're taking advantage, they should maybe just consider a different company and they can continue being great. Because some people are just being overcharged. And that's what we want to do is challenge the status quo, actually just bring up and say, hey, especially if you see one of those giant national names on a pre-approval letter, they're not in your community. They're not there to, really make sure that client's getting the best deal. They're there to serve the bank. It's kind of what their job is. Anyway, I was thinking too of some other creative ways. So I've seen a lot of times, and in talking with you, Pete, talking with other realtors, sometimes just trying to figure out, I think purchase agreements need to be more of a collaborative effort. between, if you have a loan officer that you're trusting, you can work with. It's not just, hey, we're going to offer this amount and cross our fingers, right? We talked about temporary buy downs, talked about seller concessions, but other ways too, that we're able to win. So I can say this year, I'm guessing here, but somewhere around probably 20 different multiple offer situations that we won strictly due to speed. So as far as what you're seeing out there, people, I talk about national numbers a lot. That's the data I get. What are you seeing in your market, in your area, as far as the full average closing time? What are lenders asking for?
I would say most lenders are asking for 45 days.
Yeah.
I think a lot of them feel very comfortable saying 30 days, but I think 45 days is the typical thing. And I know to that end, I think there's value in, again, communicating and presenting that offer as well. So what I mean by that is, so often you either receive an offer from an agent and it just shows up in your email. Hey, we received an offer. No preemptive call, no explanation, no nothing that comes your way. And so what I mean by that is, if you are writing an offer and be preemptive, get on the phone with that agent, have a conversation with them and say, by the way, we wrote our purchase agreement that we could close in 3 weeks or less. Okay. And that's not to scare the seller to go, oh, you got to be out of your house in 3 weeks. That's to say, we have options. We can close this thing in 3 weeks or a month and a half. It's your choice. But writing your purchase agreement that way with the confidence of knowing we can complete that early, because in some cases, particularly right now, there are people who have contingent offers accepted on another property and they desperately need to sell their house. Yeah. And now we're saying, hey, not only do we want to do this, but we have the wherewithal to close it in 3 weeks if you need to. But again, that communication level is just so darn important. And it's just frightening to me on how many deals I see where people don't communicate. They send an email, they send a text, hey, just sent you an offer. I never do that if I can help it. I will call first. Hey, Pete Mergens, blah, 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 just showed your property, love it, ask whatever questions I have. By the way, I'm putting together an offer. As soon as I send it to you, I'll text you, I'll reach back out to you, but I want to establish that rapport, create a friendly environment. But so many times I am getting offers from other agents where I never hear from them, ever. It's just shocking to me.
Right. Yeah, one of the things I've really liked is I do, as far as like pre-approval calls, I do Loom videos actually. I was doing phone calls sometimes, but I don't like leaving voicemails because as soon as they hear, hey, it's Bryan Atwood with Atwood Mortgage, oh gosh, another loan officer asking me for coffee. I get it, right? But sometimes I can put a face to it. I'm gonna show like I'm not some guy in a call center. I'm not, that's some national Super Bowl ad type lender. I'm right here. I want to help. I want to serve. And I put those videos together and I've actually won quite a few deals that specifically mentioned that like it feels way more personable. The Loom system, what is the other one? BombBomb is another one that you can send that video and you can tell when they've actually watched it. And then I've had some too that will watch it and then they'll go show it to their sellers because it's a question sometimes, right? And say like, who's doing the financing? All we can think of is Wells Fargo. That's a name we know. I'm like, well, let's show you what this can actually do. So that's a tip for everyone too. Just make your offer stand out by doing some of those additional steps. I love Loom videos. Again, it's personal. I get notified like, hey, they watched it. I know they're checking it out. If you call them and it's the wrong time, they're in the car, they're shopping, they're doing something, they might not be listening at all. That's kind of what I've noticed. But I like there has to be a personalized something for them, right? Not that typical email, typical text, whatever.
I really do feel that is a paramount issue in our industry in general, whether it's real estate or lending, whatever the case might be. There is just a huge disconnect still. Technology is a wonderful thing, but it's meant to be used in conjunction with our personal time with people. And it really is amazing to me how it has evolved in 20 years to realtors in general have become the most hands-off kind of people in our industry, meaning we don't want to comment on that building that we're looking at right now because, well, we got a inspector that's going to give us all the comments about that. You know
Right.
what water damage looks like. Hey, this is something that's a little concerning. We should check into this further. Looks like there's some seepage coming up the drywall or whatever. But I mean, just using that as an example, that a lot of agents, not speaking of our own, but meaning in general, have really pulled back from their responsibilities. And I just think more communication and more trust and belief in what you have. Seek out professionals, get advice. Be preemptive about the things that you say, that hey, I'm not a licensed contractor, but my experience tells me this looks like a concern for us. Things of that nature. So, to Bryan's point, I think communication and spending the right time with people and using your skills are things that we need to do more of.
Yeah, absolutely. Okay, a couple more as far as some creative ways to kind of, as realtors and with a partnered loan officer or broker, be more creative, help getting deals accepted, help push people forward in this. We mentioned closing timeline. The only thing we didn't say on that is, so most of the market is asking for 45 days. 30 is totally doable. I spoke with another referral partner of mine who said he had to call his loan officer on a deal recently saying like, hey, it's in multiples. I need this done in 3.5 weeks. And they did it, but he was not happy about it, right? It's like, don't make us do that again. So at Atwood Mortgage, our average from contract to clear to close is 12 days. So we like to be fast always. Sometimes that's just not in the cards. I mean, we've had some deals that are written out for 3 months. Like, well, okay, that's fine. But we want to move things along. We don't like those last minute surprises. And I always will ask, please let us know first, just in case there's things going on. I got a contract late last night that is closing the day after Christmas. So I'm like, 2 weeks, but not really 2 weeks. Okay, great. Let's do it. A lot of sleepless nights coming. But we'll get it done. And so we have that flexibility. We have certain loan partners or lender partners that are really fast. So, but aside from closing timeline, another thing to do to build confidence is just that written statement date. I know a lot of realtors that just say, I always just say a week before or 2 weeks before or whatever. Understand what the written statement is, and it can help you give even more confidence that you can get it. Written statement is not clear to close. Those are different things. Written statement, by definition, is your initial approval and an appraisal that the lender is happy with. So if we have an appraisal waiver, we might have written statement literally tomorrow. We can get it submitted today and have our approval tomorrow, and boom, we can give a written statement. If we do need an appraisal, we have to wait for that timeline. That's out of our control, but we're not waiting for, okay, the lender's ready to close. A lender commitment is just that initial approval. It's gone through full underwriting, and all signs point to this thing is going to close as long as the borrower gives us these few things. That's all it is. So you can have that date in there as well, be something a little bit sooner to show that like, hey, we're going to get the ball rolling just because, and it's a big deal. It's because a lot of you have experienced, there's a lot of lenders that if you give them a contract, they say 45 days because it's going to collect dust for 2 weeks before they look at it. And then they're going to start moving things along. We just moved personally, and it was an interesting experience. I did not do the financing for the buyer of my house. And after like 3 days, I asked for an update. I just messaged the buyer's agent and said like, hey, do they have initial approval yet? Have they ordered the appraisal yet? And we got a snappy comment back from the loan officer saying like, we've had this for 3 days, like back off. So it was just kind of funny to see like, we need to elevate our expectations and demand more of our loan partners. So closing timeline was one, written statements another. Another way to strengthen your offers is make sure that your loan officer is checking for those appraisal waivers up front. Most places don't, because it takes a little bit more work. You have to get the file into an automated underwriting system, and you have to run that scenario. This is going to be massively important next year. I say that because we already do it today as part of our standard practice, check for those appraisal waivers. If we get one, we'll put it right on the pre-approval letter. Made it that much stronger, take that element out of it. We don't have to worry about that value. Today, to get an appraisal waiver, you need to have at least 20% down. You need to have a strong borrower, and there has to be enough data on the property for Fannie and Freddie to make that automated judgment that, yeah, there's definitely enough equity here. If there's not data on the property, I've had people putting 60% down, you're still not going to get a waiver. They need to know what the property is. They might get a PDR, it's called, which is a property data report. Doesn't give a value. They just want to check it out. But it's a few pieces. So it's not just down payment gets you to appraisal waiver. The reason I say that this is going to be more important next year is because there is some new procedures rolling out where appraisal waivers, full waivers, are going to start being permitted with only 10% down payment, and PDRs, which is again, still the appraiser inspection, but no value, right? They're not going to go check in and assign a value. They're just making sure the place is safe, sound, sanitary, that it's a good property. Those are going to start being offered up to 97% loan to value, meaning 3% down. So we're going to see a ton of these as an industry. As it gets busy next year, there's going to be less and less full appraisals happening. And if you're working with the right loan officer, they can check for that before you even submit your offer. So something we'll want to be on the lookout for. So that's another strong one. And the last one I was going to mention was not asking for money in areas that you don't need to on a purchase agreement. And this is something that actually is a lending lane, even though it's a rare conversation that comes up. I know a lot of people that when they're filling out a VA offer, will get to how much, the line that talks about how much the seller is going to contribute to, repairs that the veteran can't pay for. And they'll be like, oh, we put in $200. We put in $300. This is what we always do. It should be zero. If you're working with the right lender, why are there fees being charged that a veteran can't pay for? So that's a question. And then there's big national lenders that probably everyone has worked with that you do have to pay for those things, or sellers have to pay for those, because the lender's already overcharging the veteran. And so again, just have that conversation of what do I need to put in there? Not to put you on the spot, Pete, but I will, and you maybe know the answer to this, but put you on the spot. If you're writing a VA offer for the VA funding fee, what do you write in there?
Well, truth be known, I usually call you and go, hey.
And you should.
What should I put?
Yep, and that's the point, because it's different. Do you know if this veteran has used their VA loan before? Because that changes their funding fee. Do you know if they have a service-connected disability? They might not have a funding fee. So, and then it's also kind of weird, and you can ask, it's another point, you can ask for the seller to pay for that funding fee. You can. It's not going to have as strong an offer, but if you're looking at creative ways, or those reverse offers that we talked about, another great way to say like, oh, hey, this is a veteran, ask, does he have a funding fee? It may seem like it's not really your lane, but maybe that's something the seller would chip in instead of other offers. So it's a conversation that has to happen that almost never happens. People just like, oh, I just write in 2%. Like, well, the funding fee is never 2%, so don't do that. It does change depending on if they've bought a home before with the VA loan, and maybe they're exempt if they have a 10% rated disability. I like how this sounds like a lot of information, because this should be a discussion when we're taking care of clients. We should be in the loop on this and understand, how does this one need to be written?
Yeah, one thing I would just say to that, and I am laughing out loud, because I call Bryan a lot, or I text Bryan and I go, hey, I've been doing this for a long time, but there's questions that I still have no matter what, or maybe I haven't done that type of a loan or purchase agreement in a long time, and maybe laws have changed, maybe things have
Exactly.
Just moved a little bit. Folks, we have the most incredible people. Lori Cottingham is another person. Sorry, Lori, if you're on here, I don't mean to increase your phone calls, but I have no problem calling or texting or sending an email to Lori going, hey, I'm filling out this purchase agreement, and can I do this? And that's what we have at our company. And I'm not trying to build a billboard for our company, but I have to tell you, I am seeing some of the most sloppy purchase agreements written from other companies right now on our listings. It's shocking to me that people have no idea what they're just filling things out. And I'm just putting that point out there because Bryan brought it up. Take advantage of the people that we have within our company. It's quite amazing.
Yeah, it's great, and there's just so many different markets and experiences and everything that everyone's had. It's impossible. A lot of people think I know all these things. I don't. I've been fortunate to have a lot of experiences, but sometimes like, cheapers, let's go figure that out. I know the people to call, or we know who we can reach out to, or the guidelines to look up to find the answers to better serve our clients. The people that say, to your point of been doing this a long time, to those that say they've got it figured out, they're the ones that are going to be falling the fastest, because you don't. This is an industry that changes constantly, in two industries, both on the real estate side and the mortgage side. So it's difficult to keep up with it, and it requires an active effort to be on top of it and make sure we're delivering what we're promising to our clients. Well, those are most of my notes. I did not see any questions come through. We have a few minutes left. If anyone had anything, either for Pete or myself, or just for the group that we want to talk through.
We must have covered everything.
Everything in the entire industry has been covered. Well, just for a second, in case anything comes in, please ask. We love questions, but that's I think the theme and takeaway is it's a partnership, right? You should, and it doesn't have to be with me, but I mean, you should be expecting more from loan officers. These should be a collaborative effort. I challenge everyone to say there's a lot of good people that can write loans, and if your favorite loan officer is somebody that I'm like, hey, you know what, I love them because they pick up their phone and they close deals. Like, that's like the bare minimum expectation for a loan officer. Like, what else can they do to help serve clients better and help you grow your business better? That's the challenge I want. If they can't close a loan, then obviously they're not going to be in this industry for very long. So expect more, demand more, have those conversations. I love having those. I'm not somebody that says, hey, let's go have coffee so I can give you my elevator pitch. I love having conversations of brainstorming ideas of how are you getting business, and here's how I'm getting business, and maybe there's some ways that we can do it together. Not just say, hey, you should send me your clients. Like, no, we're all working, and we all have our own focus and our own businesses, and we all want to grow. But it should always be a collaborative effort. And that's why we created Atwood Mortgage, so this can be a more cohesive experience. We don't have to say, Pete, you did a fantastic job with this client, and now you're going to send them off to Mortgage Narnia and really hope that something happens and they come back. Like, nope, this is a team effort, start to finish. So be creative. Think through some ways. Those are the realtors that are really having success. Believe it or not, in 2024, a lot of people having the one of the best years of their career, just by saying, how can I elevate? How can I be more creative? How can I win deals and build business? And we can help with that.
Well said, Brian. I couldn't agree more. Some people don't even maybe know that my own brother is a loan officer at a local bank here in Northfield, and he's been in the business for 25 years, and someone that I trust implicitly. And for me, having Bryan, who, again, it's like having two brothers in the industry now. But I surround myself with people that I trust, people that treat my clients well. And I'm not a one-trick pony. I don't just send everything to Bryan. I don't send everything to my brother. I have other people. But for me, when I'm representing a client well, I'm understanding what their needs are, and I'm placing people with who I think are going to best serve their needs. And that is a very powerful tool that I have really kind of sharpened that tool in the years that Atwood Mortgage has become involved. So I really encourage people to choose good partners, and we have one right here.
Thank you. I appreciate that. No other questions coming in, so I think we can end it there. So again, thank everyone for your time. Carla, I saw you unmute.
Thank you guys so much for presenting. This was awesome. For any agents out there that are looking for more of that experience, or to learn what is this BDM thing that they keep talking about, maybe you missed the memo, but getting involved, being that brand development manager really just does help elevate that experience for your client, both on the listing and the selling side, as we've learned today. So feel free to reach out. We're all here to help make every experience better and really looking out for your clients. I know all of you do that. So what a great asset we have here with our own mortgage department and somebody that we can literally reach out to any time of the day when we're trying to help our clients. So thank you so much for sharing all of your stories and your expertise and even the things that are coming up in 2025 that maybe many of us didn't even know were on the horizon. I mean, like you said, this industry is changing every single day. So we just want to continue to bring all of this information so that we're better equipped to help those certain situations. So we appreciate all of your time and for presenting to us today on Agent 21. Feel free to reach out to any of us if you have any questions. And we look forward to seeing you on Agent 21 next week. Thank you so very much and have a great rest of your week, everyone.
Thanks, everyone.
You.